Welcome to today's episode of Frazier and Deeter's Untangling the Technical podcast. We are offering this podcast as part of a series for manufacturing and distribution clients to help them with specific areas of complexity in accounting and reporting. We are here today with Mike Cheng. Mike is a partner with Frazier and Deeter and recently served with the Financial Accounting Standards Board, where he was a private company counsel coordinator for the FASB. During his time at FASB, Mike worked on the implementation teams for the new revenue recognition standard and the upcoming changes to the lease accounting standard. Mike, welcome to the podcast.
Thank you, Bill. I love any opportunity to talk about technical accounting, so I'm definitely happy to be here.
That's great. We are happy to have you here today as we talk about the new standard for rev recognition, also known as Topic 606. There's a lot you could talk about with this new standard, but we only have a limited amount of time, so we picked a few hot topics that we see impacting manufacturers and distributors in their accounting. So let's dive in and start with the revenue being recognized over time rather than at a point in time. What are some of the overtime scenarios that may be unexpected under the new topic?
So in step 5 of Topic 606, what you really have to do is you're transferring control of a performance obligation, right? That's the entity servicing the customer, providing good to the customer. You first have to determine whether you qualify for overtime recognition, and if not, then you jump to point-in-time recognition. And here's the 3 criteria, right? The first one is, hey, you're doing something that the customer benefits from immediately as it's being done. Think of like cleaning services, right? As I'm cleaning, you're benefiting from that immediately. Second criterion that the standard points to is, are you enhancing or doing work on something that the customer controls? If that's the case, it's going to be, again, overtime recognition. I think the third one is going to surprise a lot of folks in the manufacturing and distribution arena, and that's if you are preparing or creating some type of asset that has no alternative use, and whatever you've produced so far, you have an enforceable right for payment, then you are going to also meet overtime recognition.
So that's kind of interesting. Can you give us an example?
Yeah, so right now I'm actually wearing a pullover that Frazier and Deeter created, right? I think we commonly refer to this as swag. And, think about it. You go to a supplier that makes a pullover or shirts, and you say, hey, I would like the logo on there. Perhaps you'd like to put the name on there, and it's very highly customized. And if you think about it from the perspective of the manufacturer or whoever's creating these pullovers, there's really no alternative use, right? If I put someone's insignia, their name on it, I can't really resell that. And it might be in their interest, or it's probably very common in a contract to say, hey, as I'm producing these, if I've taken on the costs, as I'm producing them, you're probably going to have to pay me for what I've produced if you want to cancel on this contract. Now, you go back to the third criterion I just talked about, right? If the asset has no alternative use and you have enforceable right for payment on what you've produced so far, you are under overtime recognition. What do we do with that situation today? Today, you probably recognize revenue when you ship that sweatshirt or the pullover. Tomorrow, it's going to be overtime recognition, and I think that's a huge change.
So let's shift gears a bit and talk about our second topic, one I keep hearing about, variable consideration. Can you describe some issues surrounding variable consideration?
Variable consideration is under step 3, which is determining the transaction price, right? So the way I like to think about it is step 3 basically says, let's say you performed everything under that contract. What are you going to get paid, right? And if the contract says you're going to get paid $100 to do something, well, then that's pretty simple. But let's say the contract includes some type of contingency. If, for example, I do something that improves your efficiency by 10%, that's going to be measured 6 months from when I provide you the service or good. You hit it, I get another bonus. That is what we call variable consideration. There's some type of contingency out there that when it's met, it's going to change what you actually collect. So that's the easiest one, I think, to understand. What people might not be aware of is discounts are also variable consideration. So let's say you built into your contract some type of volume pricing, right? First 100 units that you purchase is going to be at $1. Once you pass 100 units, so units 101 to 200, it gets retroactively adjusted. All the units are going to be now at 90 cents. That's a form of a discount, and it's also a form of basically variable consideration, because ultimately, when everything is done and the dust is settled, what you collect might be different.
That's a great discussion, and that is common practice in the business. And of course, in my time as an auditor and accountant, I've seen multiple models to implement those discounts. Yeah. Usually everybody tries to take them prospectively because you want, like you said, we all like to record revenue. So let's move on to maybe a similar topic, which is recognizing revenue when an amount is contingent on something in the future. Under the old standard, contingent gains, for lack of a better term, were recognized usually once the proceeds became probable of receipt, right? All the criteria have been satisfied. And now we have new considerations, and a lot of manufacturers have contracts that do include incentives for achieving certain performance milestones. Can you talk to us about what people need to consider in light of the new standard?
Yeah, so I think you're highlighting a point that I raised, when I was introducing the concept of variable consideration. So today, usually if you have a bonus, right, you don't book that until the contingency is resolved, just like you mentioned. Tomorrow, if it's a bonus and you think that it's probable, you think that you can hit that bonus, and a significant amount of that bonus or what you think is going to be earned is not going to be reversed, or you're not going to actually lose that bonus, you have to estimate what that is today and record that revenue as you're transferring control of good or service under Step 5, which I think is a huge change from current GAAP, right? We have this very conservative notion of you don't record gains or revenue until you've pretty much resolved all contingencies. Tomorrow, it's if you think there's a pretty high probability that you're going to earn that revenue, you're going to be booking it much earlier.
Yes, you're right. This will be a big change. The idea of probability associated with contingent gains has always been, for accountants, considered an aggressive position, right? And the literature has always shied us away from those practices. And now we have this new topic that comes in and says, not only are we not going to shy you away from it, but we're actually going to bake it into the standard model. So that's something that obviously we'll have to keep our eye on. Our next topic shifts focus a little bit to the supply chain, in particular looking at gross versus net. There's been quite a bit of guidance in the past, and I guess literature that's superseded now about gross versus net, but I get to feel that Topic 606 provides more definitive guidance in what is actually a fairly complicated area. And it seems to boil down to the question of who truly controls the good or service just before it's transferred to the customer. Could you talk to us about these changes?
This is not a new issue, right? The whole gross versus net or principal versus agent assessment. Just some background, right? If you're considered to be the principal, what you do is you book revenue on a gross measure. If you're considered to be the agent, then what you do is you book something based on a net amount, right? So let's go through a pretty common example that I think a lot of us could probably resonate or understand. So you go to a retail shop and you buy a TV for $500, right? And the cost of the TV is $250. So the question that I'm going to have for you, Bill, is don't use any GAAP or accounting. Use your gut. What do you think the retailer is going to record as revenue when I handed you $500? You're the retailer. I just gave you $500.
I would think $500.
Right. Pretty easy assessment, right? Now, let's say you are in a different line of business and you are selling me tickets, right? You don't have any inventory of tickets. What you really do is you know what the price is that these airlines are selling a price of a ticket to, let's say from Atlanta to New York. And let's say the purchase price or that ticket price has been set at 100. But you sell it to me at 105 because what you're really doing is connecting me with the airline, right? So you charge me 105, you keep $5, and then you remit 100 to the airline that provided you the ticket, and then you hand me the ticket. Do you feel any different about that transaction and what you think you should be recording in terms of what your revenue is?
So the accountant in me says, yes, there is a difference, but obviously as a consumer, I'm going to give you $105. I figured you made $105 in revenue, but I feel you're going to tell me it's a different answer.
Yes, in that scenario, what you've really done is you're deemed as an agent, which you would have a net basis, right? So going back to what I mean is gross, for the first example, is $500 because that's the cash I handed you as a retailer. Net means that you would actually record $5. Even though I handed you 105 because you have to net the other 100 to the ticket provider, you only record $5. How do we assess it under Topic 606? And you alluded to this earlier. Basically, it's on control, right? So right before that good or service is ultimately handed over to the customer, did you, as the entity, control that good or service?
And it sounds like in the case of the ticket, the agent doesn't really control the ticket until he or she has executed a transaction with an end user.
I think it's you actually just handing me the ticket because you have no inventory risk, right? I mean, if you control something, you should have the risk of maybe the ticket prices or the value of the ticket. You probably weren't able to set the price of that ticket, right? The airline told you, hey, it's $100. That's what you're going to sell it for. Now, contrast that with what you looked at earlier in terms of indicators of control. Do you think if you're the retailer, you actually control that TV?
Probably so. It's probably sitting in my warehouse, and I bought it straight up from the wholesale distributor.
Right. You could probably set the price. You could set it at a loss if you want. If there's a hailstorm that hits your warehouse and the TVs are destroyed, I mean,
my insurance company.
Yeah, right. So those are all indicators that you as the retailer controlled that good before you handed it over to the customer, and that's why you're the principal. Whereas in the second scenario we talked about, you didn't really control that ticket before you handed it over to the customer, and that's why you were considered to be agent, or you would record on a net basis.
Good discussion. Gross versus net has always been an issue. There are old EITF issues about it. There's been SEC guidance around it, and so I think this is something, an area that will continue to receive attention as people work through Topic 606. So the good news is we're coming around the corner on our podcast, and a couple more topics to go through. Next one is shipping and handling, which is another common charge for manufacturing and distribution companies. What are some of the more complicated points that we need to consider now under Topic 606 related to shipping and handling?
So the first question you're really going to have to ask yourself, right, is did you ship that good before you transferred control to the ultimate customer? So meaning, when did transfer of control occur? Did it occur before or after the shipment? If it occurs after the shipment, then you just recognize the shipping costs as it's incurred, and then it's part of your transaction price, right? If that's not the case, then what you're going to have to do is figure out whether you're the principal or the agent on that shipping and handling, and that could be a very, very difficult exercise. To make a long story short, what I would probably recommend most people doing, if they're comfortable with that, is there's this practical expedient or this election where you can just treat all shipment activities as a fulfillment activity, meaning whether you transfer control before or after the shipping activity, just assume that it's part of the process of fulfilling or transferring that good or service. You always include the cost as a cost to ship, and then you always include shipping in your revenue. And it's pretty much an easy exercise. But it's an election that you have to be aware of and understand up front.
And I assume once the election is made, it's one of those consistency things where you really have to stick with it year over year.
Right.
And not just because it gets a little...
Right. This would be an election, an accounting policy election.
For our final topic today, we wanted to talk through what happens when you modify a contract. Here again, this is a routine business practice, but Topic 606 has introduced some new considerations. What are some of the things that people need to think about as they move into Topic 606 when they modify a contract?
Yeah, I think this is a very good point. Today, right, under Topic 605 or whatever you follow for revenue recognition, because it's so fragmented, there really isn't any on-point guidance and gap on how do you account for basically a change in a contract. And we know in real life things change all the time. There's change orders, things don't really always go according to plan. And when you modify stuff, there's going to be accounting implications under Topic 606. But in broad strokes, there is now guidance. You have to follow it. This is what you have to do, right? So if you make a modification to a contract, and let's say that modification is adding goods, I'm going to provide you more widgets, right? And that additional increase is also going to increase the contract price to what you would expect to pay for these additional goods. That's not really a contract modification. Topic 606 will say that's just a new contract. Account for that separately, all right? Now let's say you make another modification where I change something in the future, but what I do in the future is totally distinct from what I already provided you before. If that's the case, then what you're probably going to focus on is accounting for this on a prospective basis. Meaning, I just added another 100 widgets, had nothing to do with the 100 widgets that you provided me. I'm going to account for this change prospectively. Now, if what you changed also relates to what I've already performed, the easiest, I think, concept to understand here is if it's one performance obligation where I'm customizing something for you and I'm halfway through and then suddenly you say, hey, I want this add-on, but it's still just one performance obligation, well, that change that I've actually incurred actually relates to work that you've already done before. In that case, you're going to have to book a cumulative catch-up adjustment, meaning if you think that you're going to earn $200 once everything's done and settled, right, originally, and 50% has been completed, you have already recorded $100. You do a change order, and now it's going to be for $300, right? When everything is done and settled. Well, now 50% of 300 is 150. You've already recognized 100, so I now have a cumulative catch-up adjustment of $50. I literally book revenue on that modification because now it relates to something that's already been done. I'm going to earn more, and if you still think I've completed 50% of the work, that would be a cumulative catch-up adjustment.
So this is distinct from variable consideration because the contract is what's driving the change, or the change in contract is driving the change in accounting, as opposed to a change in estimate or a change in price that's built into the existing contract, which is the variable consideration element. So again, some complicated topics that might seem the same on the face of it, but they need to be sort of unpacked and looked at separately under the framework, and that's a large framework, and I'm sure people have heard lots about it, and they'll hear lots about it to come. Really appreciate the time you spent with us today, Mike, and I want to thank our listeners for joining us and following our Frazier & Deeter podcast.
Thanks for having me.
Thanks for listening to one of Frazier & Deeter's branded podcasts. To learn more, connect with us on LinkedIn or visit us at FrazierDeeter.com and be sure to subscribe so you never miss an episode.